Hello, and thanks for joining me. My name is Travis Dyke, and this is another episode of the Business Growth Series brought to you by the Chamber of Commerce. The Chamber of Commerce has asked me to introduce myself. As stated, my name is Travis Dyke. I was born and raised in the Cambridge area, and I'm happy to return and join the esteemed team here at Pavey Law. My practice is in the area of corporate commercial law, wills and estates, as well as real estate. When polled on what they would like today's discussion to be, the members of the Chambers of Commerce overwhelmingly agreed that the discussion should be on legal topics. So, in honor of November, which is Ontario's Make a Will Month, I decided to discuss one of my favorite legal topics, estate planning. Specifically, what I want to go through in this discussion is a step-by-step on the legal process on what happens when you die in Ontario. And we'll be looking at the negative impacts that different legislation has on the distribution of your estate. We'll go through strategies on how to minimize those negative impacts, as well as we'll look at common mistakes that people tend to make when trying to implement these strategies. We'll start our journey through the legal process, where most of the people watching this should be alive. The first mistake that most people make is simply not having a will. To use the often cited quote from Benjamin Franklin, the only thing that is certain in life are death and taxes. Despite this, a recent study by the National Institute of Aging found that less than half of Canadians have a will, and significantly less than that have a valid and comprehensive estate plan. The survey found that the reason for this lack of estate planning was simple. People did not know where to begin. So, let's look at what the difference is between a will and an estate plan. They're basically two sides of the same coin on what happens to your assets after you pass away. A will is the documented intention of how you want your assets distributed. It is so important for how you distribute your assets if you want a say in how they're distributed. If you do not have a valid will in Ontario, the Succession Law Reform Act dictates how your assets are distributed. While a will is a powerful tool, the Ontario Superior Courts have ruled that while the will maker is living, the will itself is worth nothing less than the paper it is written on. The reason for this is at any point you can change a will that you've created. An estate plan, on the other hand, is what you do with your assets while you're alive and how you arrange your affairs in order to minimize the negative impacts of different legislation, including potential and significant taxes. We often find that the estate planning is much more significant in negating these negative effects than the will itself, as many of the strategies are no longer available once a person has passed away. The next step in our legal journey is to look at what happens immediately before you pass away. I want to pause here to ask a question. What do you think every Canadian does with their dying breath? If your guess was to immediately sell all of their assets for fair market value and then buy them back, you'd be correct. At least this is what the Canadian Income Tax Act deems every Canadian to do. Now, what's the effect of this? Well, for most Canadians, it means capital gains tax. If you started your own business, or if you've held property for a significant amount of time, the capital gains tax could be to the tune of hundreds of thousands, if not millions of dollars. So, what are some estate planning steps to mitigate the capital gains? The first is trusts. The Canadian Income Tax Act deems you to only sell the property that you owned as of the date of your death. However, assets held by trusts are owned by the trust and not by the deceased. Historically, trusts were a lot more popular tool for estate planning. However, recent amendments to the Income Tax Act now tax income earned in a trust at the highest marginal tax rate. Second, new reporting requirements have made settling and running trusts significantly more onerous. The next means to reduce the capital gains tax is to take advantage of the lifetime capital gains exemption. This is available on the sale or deemed disposition of shares of a qualified small business. Currently, the capital gains exemption sits at just around $1 million. Next is spousal rollovers or spousal trusts. This is probably the most commonly used one. Any assets that are distributed to the spouse of the deceased or put into a spousal trust for the deceased have what is called a capital gains rollover. That means instead of paying capital gains on the death of the deceased, the spouse is deemed to have acquired the assets at the adjusted cost base of the deceased. This means capital gains are not payable until the spouse of the deceased has also passed away. The next two methods to reduce the capital gains owed on death have a pretty strong policy reasons for why they are in place. The first is the exemption for qualified farm and fishing properties. Now, the obvious reason for these ones is that we, as Canadians, want to have the least discouragement as possible to encourage people to both fish and farm in order to feed the people of Canada. Next is the principal resident exemption. So again, the policy reason behind this one is that typically when people sell the house that they reside at, the reason they are selling this house is for the purpose of purchasing another house. And the Canadian government has deemed it necessary not to force capital gains tax on this in order to facilitate the purchase of the next house. Therefore, both of these can also be used on the deemed disposition of death of all Canadians, thereby reducing any tax owed. This next strategy, the corporate insured retirement strategy, is what we would call a relatively new strategy in the estate planning field. However, if you meet the ideal qualifications, which include qualifying for life insurance, as well as having excess capital in a corporate structure, this can not only be a highly effective way of reducing capital gains, it can also reduce estate administration tax, which we'll discuss next, as well as be an effective method of investing funds. So instead of taking excess funds out of a corporate structure, which would immediately be dinged on dividend payments or income, or leaving the funds in the corporate structure, which would be unfavorably taxed on any funds exceeding $50,000. Instead, what this method suggests is purchasing a life insurance policy through the corporation on behalf of one of the shareholders. Once the shareholder passes away, the life insurance policy pays out. Since life insurance policies are not taxed, this would significantly reduce any capital gains tax that would be owed. In addition to this, if excess funds are put into the life insurance policy, the policy can also be leveraged to take out a loan on behalf of the shareholder, giving access to cash during the shareholder's lifetime. And that concludes our look on what happens immediately before passing in Ontario. Now, you may have noticed that aside from the trust, there wasn't too many mistakes that took place in that process. That is because most of these exemptions are actually legislative exemptions, and they're available to everyone, and it's hard to screw these up. However, as we move on to our next stage in the process, after you've passed away, these are where we typically see the mistakes arise. So, after you've passed, we're going to assume for the sake of this presentation that you're all smart people, you listened to the talk, and you all went out and got wills. Therefore, in your will, you've named someone as the executor of your will. The executor is in charge of administering your assets in accordance with what your will has set out. Now, in order to start this process, the executor is going to have to apply for a certificate of appointment. This is commonly known as probate. What this is applying to the court for the court to validate that the will is in fact the last will and testament of the deceased. Now, in order to have a will probated, your executor is first going to have to pay estate administration tax, also known as probate fees. So, how do you get around estate administration tax, which is taxed at 1.5% of the value of all the assets you have exceeding $50,000? Well, the best method is that not all assets need to be probated. Assets that need to be probated are ones that have what we'll call gatekeepers. So these will typically be other institutions that are holding your money on your behalf. So this can be banks, this can be investment advisors, typically any financial institutions. The other asset that has the quote-unquote gatekeeper is real property that has been transferred into the land titles registry, which is at this point most of them. So in order to reduce estate administration tax, the best method is to have as few of your assets actually requiring probate as possible. The first and one of the simplest ways of doing this is to designate beneficiaries on registered accounts. So these can be RRSPs, RIFs, TFSAs, anything of those sorts. What happens is once you've designated a beneficiary, on your passing, these funds will automatically go to the designated beneficiaries and will what we call pass outside of your estate, and therefore no estate administration tax is payable on these. A similar method evolves under life insurance policies and, as we discussed earlier, the corporate insured retirement strategy. On both of these methods, again, a beneficiary is designated and the payout from the insurance policies pass outside of your estate. The next method, and one that typically requires some legal help, is secondary wills. Now, how the secondary wills work is almost entirely how it sounds. You would have two wills. The first will is for assets that are blocked by the gatekeepers. The second will list all the other assets that your executor can administer without having to go through the gatekeepers. These assets can include shares of privately held corporations. It can include artwork. It can include jewelry. Some real estate that's open to the first dealings exemption. It can even include your unopened boxes of VHS. Now, one of the Howey stakes on this method is what we call tainting the secondary will. This can be including anything in your secondary will that does require probate. By accidentally putting in any assets into your secondary will that require probate, it requires the entire will to be probated, opening up all of your exempt assets to probate. One of the other downsides that we typically hear about is the upfront costs of implementing a secondary will. Typically, a secondary will, obviously, costs about twice as much as just having a singular will. However, to give you an example, let's say you own a company that is currently worth about $5 million. If you pay the extra, let's say $750 to implement a secondary will, you could immediately reduce your probate fees by $75,000. Not only does it reduce probate fees, it also reduces any ancillary fees that may be required. In order to apply for probate, your executor is going to have to give a value of what they believe the company to be worth. In order to do this and to avoid committing tax fraud, they'll likely have to hire a valuator to determine the value of your corporation. So not only do you reduce the probate fees, you reduce any fees that would be required in valuating assets that could be part of your secondary will. The next method, and the one we see the most mistakes in, are in jointly held assets. Assets where the owners hold title to the property jointly immediately pass to the surviving joint holder. Now, where the mistakes come in is that when a parent will add their children, adult children, to title to property without any consideration, so without any payment given by the adult child. The first mistake and problem that people don't consider is that by doing this transfer, you immediately lose control over the asset. By adding an adult child to title to your house, you now may require that adult child sign off on any mortgages or sales that you may have moving forward. The second issue is that you are now opening that asset to be seized by the adult child's creditor. If your child owes any money, this asset is now available for their creditors to seize in order to repay your adult child's debt. Next one is the loss of the principal resident exemption. If you transfer title without any extra documents onto what your intention for that transfer is, it is deemed that your adult child now holds 50% of the legal title and beneficial title to your house. Therefore, if you sell your house before passing away you may lose the principal resident exemption on 50% of the increased value of your house. Therefore, paying significantly more taxes and capital gains tax while you're alive than you could have possibly saved on estate administration tax after you passed away. The next issue with using jointly held assets in your estate planning is that without the proper documentation of what your intentions are, the government assumes that the property to the title was passed as a resulting trust. What this means is if you put your child on title to the house and you pass away, the presumption is not that you decided to gift the house to the child, but that child is now holding, that adult child is now holding the house in trust for your estate. Right now, this is typically one of the most common estate litigations we see, the resulting trust on houses. However, if you have the proper documentation at the time of the transfer that your intention was to gift the house to the child, you can rebut this presumption of resulting trust. However, this requires proper documentation. It can also have unintended estate distributions. The first unintended estate distribution is what we'll call an unequal distribution. Let's say we have a scenario where you own a house worth $700,000 and you have a bank account worth $700,000. Your intention is to gift the house to one of your children and the money to your other child so that they each receive an equal value. If you add the first child as jointly to the house, what will happen is after your passing, capital gains may still be owed on that house. Therefore, since the house passed outside of the estate will still be liable for any capital gains tax that may be incurred. Therefore, the child who was going to inherit the money will now receive less money as capital gains tax will be owed by the estate. The second one we see is typically in a will. We have what we will call a just in case clause. Just in case one of your children predeceases you, you want their assets to be passed to their children, your grandchildren. If your only estate plan for your property is to add your adult child as a joint owner, what may happen is if you don't include something in your will, that asset will then be distributed to your surviving adult children as opposed to your deceased child's children. Finally, another method we see that people commonly use to try to reduce estate administration tax is to gift assets before they pass away. While this may seem like an easy and straightforward method, It's subject to the same resulting trust as jointly held assets were. When you gift assets to your adult children, there is a presumption of resulting trust and that those assets are being held in trust for your estate. Again, this can lead to some significant legal costs should estate litigation arise on these resulting trusts. This can be easily solved with proper documentation at the time you gifted the asset to your adult children. Again, these are some of the common methods for reducing estate administration tax, as well as a few of the most common mistakes we see people make when trying to implement these. So this brings us to an end on the step-by-step process on what happens when you pass away and what are some of the tax implications and the common mistakes we see on people trying to reduce the tax implications. The last thing I want to leave you with is a quick discussion on testamentary freedom. Testamentary freedom is a legal concept that, upon your passing, you get to decide what happens to your assets. Now, we've looked at a few of the tax implications that may limit your testamentary freedom, specifically in reducing the amount that you gift to your beneficiaries. These include provisions from the Canadian Income Tax Act and the Ontario Estate Administration Act. I want to touch on two more legislations that limit your testamentary freedom and may have an impact on your estate planning. The first act is the Ontario Succession Law Reform Act. In this act, there's what is called the Dependents Relief Claim. This claim is essentially where if you have not left adequate provisions to someone who is dependent on you, financially dependent on you before your passing, they may bring a claim against your estate. This should always be considered in your estate planning, as it may limit your testamentary freedom. The last is the Ontario Family Law Act. In a similar vein as the Succession Law Reform Act, the Ontario Family Law Act looks after spouses who have not been adequately provided for in a will. If a spouse has not been adequately provided for in their deceased spouse's will, or the deceased spouse has an option for the net family property equalization. This follows a similar method as if the couples were to separate and get divorced, and may entitle the surviving spouse to more than what was left for them in the will. However, before opting for this claim, a spouse should seriously consider whether it is worth it, as by opting for the net family property equalization, they're no longer entitled to what was provided for them in the will. And my final thought. A legal disclaimer that none of this was intended as legal advice. It was the hope that this 10,000-foot view on estate planning could provide some knowledge to people in where to begin. However, it barely scratches the surface of the possible outcomes for your estate plan. The best estate plan will be on a case-by-case basis, and I strongly suggest that you seek legal advice in implementing the most effective estate plan. Because while lawyers can't help you with the death part, we can hopefully help you with the taxes.